the lesson is going to be, where do high probability fair value gaps form? Now, there's fair value gaps forming on all time frames, but what differentiates it from a high probability and a just simple common gap? And that's what we're going to cover now. When we look at price action like this is a simple 15-minute chart. There's a lot of things in this chart, but I want to keep the focus on just the fair value gap and what differentiates a common gap and a fair value gap. Before I get into it, again, a fair value gap is an imbalance on a very short-term basis between three candles. Okay, one single pass candle between the candle to the left and the candle to the right of it. Now, it's important to know that just simply because it creates a fair value gap doesn't mean that you hold out forever and look just for that to fill. It doesn't have to fill, which is the reason why I taught you the institutional order flow entry drill. It requires just the shortest time frame of a violation or entry back into the gap. The gap can remain open, or it can be filled partially. It could be half filled, 3/4 filled, or it can go slightly beyond the gap closure. None of those invalidate a fair value gap. It's just that the fair value gap is that signature that we look for an imbalance on a short term. And IPTA will want to go back and rebalance that price point. There's a lot to say about daily highs and lows, but I'm going to teach you how they're important as it relates to fair value gaps. So if we look at a chart and we start adding some details, okay, adding lipstick, if you will, you want to note the daily highs and lows. Now, it's important to note these levels because you should have them not only in your notes before you even sit down and look at the charts, but you should have them in your charts themselves, because those levels are going to be very influential in the future, especially looking back the last 3 days. So, remember when I first started teaching on baby pips, I said that I look at the last 3 days. Okay, so why is that important? Well, swing highs and swing lows form, but also the fair value gap. So, but the last 3 days is important because of pivot swing highs and pivot swing lows, and the formation of fair value gaps, because a fair value gap is defined by 3 candles. One single pass candle in the middle, where there is no back and forth delivery of price. It's usually one-sided, and you look at the candle to the left of it and the candle to the right of it, and that defines your fair value gap. That phenomenon is fractal, so it exists on all time frames. The element of the daily high and the low is very important because that's where a lot of the interbank dealing is going to be utilized. So if you look at this chart, I have the daily highs and lows denoted on 3 of the days. Friday, I don't need to have it because it's Friday and the end of the week. I noticed last Wednesday that the Aussie dollar was looking, it would most likely want to reach for its sell-side liquidity pool on a daily chart. So we had a draw on liquidity, which is 68.65, okay, or liquidity below that level. So you have to have the directional bias on the market. That's what makes a high probability fair value gap, number one. You have to know what it's reaching for. So if we look at the daily high and low on the 12th of June, okay, I've measured the daily high and low with a fib. I've just basically highlighted the 50 level, and I'm annotating it with equilibrium of the daily range. Now, what that means is it's the equilibrium of the 12th of June, 2019. So that price level is what we're looking at. High probability fair value gaps, when the market is bearish, in this case, like I mentioned on Wednesday, that we would most likely see Aussie dollar probe its 68.65 level on the daily chart. So it gave you directional bias. It gave us a draw on liquidity. The most important factor had already been determined, which is where is it reaching for? So how do we take this one step further when we know that there's a strong one-sided directional bias on a market, whether it be your pet pair or in this case, like we saw on Wednesday, I rung in Aussie dollar. Now, so with that said, what makes high probability fair value gaps and where do they form? When we're bearish, and everything I'm saying here, you just reverse it when it's bullish, but we've split the daily range on the 12th of June. The equilibrium of the daily range is this level right here, okay? So this range to the daily low, that is your sweet spot, if you will. You want to be seeing a fair value gap form in the lower half of the previous day's range. That's what's showing here, okay? So now, why is that important? IPTA will not want to go back above the previous day's midpoint, okay, or equilibrium, once price sweeps below the low, like it does on the 13th. Price drives aggressively down like that. It should never, ever, ever come back up to equilibrium. Okay, if it does, that's really implying that there may be a deeper retracement required or an outright reversal. When we have a fair value gap form in the previous day's low to the equilibrium, as we see right here, we have a fair value gap inside of the range between the equilibrium of the previous day's range, which is this low, to the midpoint up to that high. So on the 13th of June, which starts here, the market does what? During Asia, which is a sweet spot for Aussie dollar, okay, so that's like the really, really nice responsive time for Aussie, New Zealand, and yen pairs. So this is all really applicable to all pairs, but when we're talking about Asian session, those three are specific. So we have a fair value gap. We want to see price run above this up close candle's high. That's all that's necessary, okay? But we do get consequent encouragement, which is the midpoint of the gap. Price dries up during Asia. That's your Judas swing. Right there, that's the moment when you would be looking to go short. And why? Because it's in the lower portion of the previous day's range, the lower half of it. Price will not want to go back up to that. I mentioned that if we go below this daily low, it should never want to go back above that. That's why you want to keep your stop there until you take first profit. Okay, so in other words, if you take a short here, the stop has to remain there, or above it rather, before you take first profit. And then you can start mitigating some of that risk from your stop loss and trailing a little bit closer. Not jamming it up to break even, not jamming it up to plus 20 or 10. You just want to start reducing it. Keep it away from the markets, so that way you're managing what the market's doing right now and keeping your focus on what it may still be reaching for, which is down here. Okay, so if you jam the stop from above here, right below this low, you could really get tagged out, because this retracement here could have came back and hit the daily low, the previous day's low. It can do that. That's your standard support broken becomes resistance theory. Okay. In this model, I want you to think whenever we have a fair value gap and it's inside of the lower portion of the daily range of the previous day, okay, in other words, like yesterday's daily range, if we divide that in half, in the lower half, when we're bearish, if there's a fair value gap that's formed, that's a high probability, especially if we know there's a draw on liquidity lower than we're at now. But the fair value gap, and defining it for high probability, this is what it looks like. It's going to be in the lower 50% of the previous daily range when bearish. If that happens, then you know that you have a high probability fair value gap, and it occurs during a kill zone, which is the Asian kill zone. Okay. Now, if we know that is the rules, same thing applies here on Friday. We have previous day on Thursday, the daily low, the daily high. Let's split that range in half. Then we have equilibrium of the daily range, previous daily range. So from this point here down to the low, if a fair value gap forms and we're bearish and we have not traded to the draw on liquidity yet, if price trades up into it, here's the fair value gap, and here's London. It trades up into it. It does what? It goes right above the equal highs. Doesn't need to go much above it. That's all you use, the order flow entry drill. That entry gets you short for a run to the draw on liquidity. There's your fair value gap. This is the range that you have to look for the fair value gap to form. Look over here, you can see it right there. Okay? So inside of the range of the previous day, splitting that range to the low, that can form a fair value gap inside of the previous day, or it could exist or be formed in the new day like it does here on the 14th. That's your caveat, okay? Don't think that the fair value gap has to form in the previous day, because it's not required. IPTA does not have limitations in terms of time to that degree. It will look for the imbalance, but it's going to frame it based on these factors, okay? So I've given you a huge element of some of the things I'm going to talk about in 2020. They're algorithmic in nature. So why certain things are being seen in price action and they repeat themselves over and over and over again, it's based on the fact that IPTA will do these certain things because the arrays that it's using to frame certain ranges, they're there, but they've always been there, but you're not seeing them, and you don't know how to build a context around them, and that's what I've shared with you tonight. Looking at it on a 4-hour chart, you can see those are the fair value gaps, and you can clearly see if you wanted to be a larger trader, you can see it exists here. And then obviously the daily, we mentioned on Wednesday that we would see these lows be taken out and probed. And then we see power 3 on Thursday, open, rally, Judah swing, down, close, open, rally, Judah swing, down, close. Both of the Judah swings in here were basically fair value gaps to be used for shorting purposes going into that 68, 65 liquidity pool on a daily chart. That's going to be it for this lesson. Obviously, there's a lot more to talk about with fair value gaps, and we know there's other PD arrays that we have to cover. So that's what I'm saying. There's so much content and so many things that you need to learn, but you have to do it in bite-sized pieces and then study it, look at it, and you'll start over a period of time, start drawing parallels to certain things, and they will come together. All the ICT concepts will dovetail nicely over time. But right now, they feel disjointed, they feel fragmented, they feel like I don't know when certain things are supposed to be used. Well, you have no excuse for when to expect a fair value gap, because now you know exactly when they're going to form, in the form of a fair value gap that's in a high probability, not just a simple gap. Fair value gaps that exist in the previous day's range when bearish, the lower half. Now, if we're bullish, we're going to be using the previous day's range, dividing that in half, the equilibrium, to the previous day's high. That's where the bullish fair value gap is going to form when it's high probability and it's a kill zone. Okay, so when you have those elements, it's a locked, loaded, it's so one-sided and in your favor. Those are really good times to trade. Now, contrast that with all of the times where you practice with your demo account and they didn't pan out. You may have thought you saw a fair value gap, okay, or maybe there was a fair value gap and it just was a losing trade. If you look at price action, very rarely, okay, it's so rare that a fair value gap trade, when you have a draw on liquidity outlined beforehand, they rarely ever fail. Now think about that. Now, I don't think you've really put any thought behind all of that, what I just said, but when you see a fair value gap form in price action and it trades into the order flow entry price point minimum, okay, or goes to consequent encroachment or fills entirely, if you use the low-hanging fruit entry, which is the order flow entry technique, if you're using that, it's assuring yourself that you're going to get in the trade. Now, some of you may want a higher, tighter entry for shorts, okay, or a very low discount entry for longs and fair value gaps. When you do that, you're opening up yourself to missing the trade. So I don't demand that much of precision on my entries because it's the least of the important factors. Knowing where the market's reaching for, that draw on liquidity, that's where all your homework and your time is supposed to be invested. I've given you dozens of ways to enter the trades, and you only need one. But you may not get a fair value gap. You may get an order block, or you may get a mitigation block, or you may get a breaker. Okay? So just know that we're graduating through each one of the PD arrays, and we'll be doing things like this on all of them. You think you know order blocks, and you don't know order blocks at all. There's so many things that we're going to be teaching with that as well, but you can see that we're mining fair value gaps pretty deep, and we haven't even really scratched the surface yet on this PD array. So again, I'm counseling you to go through your charts and look at the framework what I just gave you here. And I'm telling you, you're going to have a hard time sleeping, okay? Because it's been there all this time, and once you see it and you understand what it is that is outlined here, it's gold. It's absolutely a Midas card, because if you understand this, you will never be without a method to find setups. You just simply wait for them to form.